Hey, Jason here. In today's video, we're going to do an investment analysis of AMC Entertainment, major holders of AMC theaters, major short seller slash hedge fund slash Redditor fight recently. I got this request from Kajona E on YouTube, and we're going to cover them in today's investment analysis. Before I get to that, though, I need to let you know you get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, Spotify, SoundCloud, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video and our other videos, make sure to like, love, share, subscribe, and hit the notification bell so you're notified every time we release a new video, and release new videos all the time. Okay, before we get into the bulk of this analysis, again, I apologize for this, but every time I forget to do it, somebody gets all nasty in the comments. So I do not short sell. I do not own any stock in a long position in any stock I talk about on here in any of these videos. I have no personal stake either way in these stocks. I'm doing my personal initial preliminary analysis screen, the visual part of that, for educational purposes only, to help you become better able, to help you understand how to better able find better stocks faster, and more importantly, how to discard crap companies fast, so you can find better stocks and spend more time researching those. Okay, again, I apologize for that, but I have to say it every time I forget. Comments get ugly, I'll put it that way. Okay, so let me get you over to my other screen here. And while I'm doing that, okay. Also, I will probably reference prior videos in this. If I do, especially if I talk about something like book value or impairment or stuff like that, I'll reference certain videos. And all of the videos I reference, and frankly all the videos in this series, you can get in the description below this for free. Okay, so again, if you haven't seen any of these videos before, most of these videos, or most of these stocks that I've researched, or that I've looked at in these videos, sorry, I haven't researched before. I have researched this one to a small degree, because when it fell earlier this year due to the COVID crash, I was like, is this going to be a deep value play? I never bought it. So I do have more context into this than most of the companies I talk about. However, this is essentially a brand new analysis, because that was back in, I think, March, April, May, June, sometime when I looked at AMC theaters. So the numbers have changed quite a bit since then. Okay. I think it's the US's largest theater holder, or it's certainly one of the largest. Nothing of major note here. Revenue cratering is not good. I assume, and if I remember right, I think they merged with another theater company somewhere in this time frame, 2016, 2018, 2019. I think they merged, which is why their revenues jumped so high. Could be the Marvel thing as well. But the revenues falling from $5.5 billion last year to $2.5 billion this year is a fall. That's the lowest revenue since 2011. That's a gigantic fall in revenue. Again, most of that due to COVID restrictions, at first completely closing down theaters, and then now that they're back open, people not going to theaters as much because they don't want to be locked in a room with people who might have COVID. So, and that led to a just absolutely, sorry, my dog is barking, I'm not really sure. Hopefully you can't hear that. I apologize if you can. Operating margin, again, cratered from typically in the 4 to 8% range over the last decade to negative 38%. I look for anything above 10% on a consistent basis, so this doesn't meet my minimum threshold over the last decade anyways, but the negative 38 cents, or negative 38, I was thinking of the next step, what I was going to explain. The negative 38 here is gigantic. They lost $1 billion in operating profit in the last year. And what this essentially means, the way I like to explain it to students, is for every $1 in sales AMC produced in 2020, yeah, it hasn't updated over here to the full 2020. In the last 12 months, it lost 38 cents for every dollar in sales, which of course is not good. Net income again cratered to negative 3.7 billion, rounded up. To put that into some context, that's more net income than it earned in the entire decade. Shared book value. Book value again cratered. I'm assuming there was some kind of impairments here. I don't know why that would have fallen so much due to COVID, unless there was some kind of impairments or write-downs or something like that, which we can check out. Free cash flow again cratered, negative 730 million, 29 million, sorry, in the trailing 12-month period. That's at a quick glance about the same or more than the entire free cash flow they produced in the last decade. So the reason I've said that is, again, to put this into context for you, that means on a net income basis, free cash flow basis, that AMC lost more in 1 year than it made in all the last 10 years combined, which is, again, frankly, shocking and devastating. ROIC is unreadable. Frankly, I'm not sure why, because even if this goes negative, it can be red. So I'm not sure why that's not showing up here. But I can tell from past years, and also what I know of the company this year, that they've issued a lot of debt, which is usually what I look for at ROE for. Again, free cash flow to sales, I look for anything above 10% on a consistent basis here. Or 5%, sorry. I look for 10% and above on the ROIC back here, which it does not meet for the last decade. And free cash flow, I look for anything above 5% on a consistent basis, which it does meet some years and does not meet other years. But this year, again, negative 28.8%, which is a huge cratering of that rate. Intangibles, so it looks like they might have written down some stuff because their intangibles are a lot lower than they were in 2019 and 2020 than they were in 2018. So there might have been some write-downs and stuff there, which goes back to the book value stuff that we talked about. Long-term debt. Okay, this isn't good. Haven't seen this in a while. So what this total stockholders' equity means, being negative at negative 21.86%, is that the company has more liabilities than it has assets, essentially meaning that the company's book value is negative, which also means that because the book value is a very basic proxy of the value of the company, and this is essentially what you could sell the company for in a liquidation situation, like a fire sale situation where the company's going in big trouble and needs to sell stuff, which until recently AMC was in that situation where it might have had to do that kind of situation. It essentially means, another way to look at this is, after subtracting all liabilities from all assets, the equity of the company's shares, the stock you buy on the market, is worth less than zero. Yes, that doesn't play out pretty much ever, but this is one sign that the company is in massive trouble, and it is, and it was until recently, which I'll talk about in a little bit, which it might have, or it got a lifeline not too long ago, which should save it from bankruptcy. But for the most part, since the pandemic hit, it was in major danger of bankruptcy, and this illustrates that right here. Cash conversion cycle. Frankly, I don't know why there's a number here. I wouldn't, unless they're like counting popcorn and soda sales and stuff like that. I wouldn't have thought the cash conversion cycle mattered much for a theater, but again, maybe they're counting like popcorn and stuff and those kind of sales. Okay, nothing else there. Interest coverage ratio, I've talked about this in a few videos where we've seen this. When it's negative, like it is here, it means the company cannot cover its current interest payments on its debt with net income or earnings, which, because those are negative, that makes sense. Again, this means the company is at higher risk of bankruptcy, because if it can't pay at least the interest on its debt, again, depending on the covenants in the debt agreement, it could be put into bankruptcy proceedings. Again, I'll talk about that in a minute, what came of that recently. But typically this is not good. Anything above +1 means the company can cover its current interest payments on its debt with net income. Being negative means it cannot. Okay. So this is the number one reason back in, again, I don't remember which month it was, March, April, May, June of last year, 2020, is when I originally looked at AMC. This is why I decided to avoid the stock. Even though it was at that point undervalued, I didn't buy for this one reason right here. Because it has $11.3 billion in debt versus a market cap of around $2 billion. Even after you subtract the cash of 420 million-ish, that means the company has net debt of about, what is that? 10.9-ish billion dollars in debt compared to a market cap of $2 billion. Again, another way to look at this is when subtracting all debt from the company's market cap, the company has a negative equity value, which means the shares on the market are worth less than zero. Again, that's not an apples to apples comparison in a real world sense most of the time, but it illustrates how much trouble this company is in. You rarely see a company that has more liabilities than assets unless they're in bad shape. It's even rarer if you see a company that has just net debt alone, not including its other liabilities, that leads to negative equity value. This is the number one reason right here that I avoided its stock back in, again, sometimes last year, whenever that was. Okay. And they took on a ton of debt to survive the crash, the COVID crash. It's not really, that's current debt, that's why. So they had a lot of debt before the crash. They've taken on even more since. They had $9.6 billion in long-term debt in the third quarter of 2019. Now they have just under $11 billion in long-term debt alone. And again, just to stay alive. There's the negative equity value right here, which I already talked about. So I wasn't going to talk about this, but this is important. So the retained earnings here, in this case, accumulated deficit. When this is, if it's retained earnings, it's the entire, or the entire profits the company, in terms of net profit, that the company has earned over the lifetime of its entire business operation. So if this AMC Theaters became public on, let's say, 1960, this would be the entire profitability of the company since 1960. In this case, it's a massive loss, which is an accumulated deficit, which means since AMC became a public stock, it's lost a cumulative total of $4.4 billion. Now, most of that, actually, about 90% of it, has happened since the COVID panic. When accumulated deficit is negative, it's a drag on the value of the company and the value of its shares. When it's positive, it can increase it because you can kind of look at it as a rainy day savings fund. If you earn excess profits, then you can obviously invest those excess profits, pay down debt, issue or buy back shares, pay dividends, stuff like that. If it's negative, you typically don't do those things because you can't. So this is a massive drag in the last year on the company value, which frankly is illustrated. Let's go up here. To here. So in 2016, 2017, it had a share price of $35. At the beginning of 2020, that was down to about $6-7 a share. Now it's $5.75 a share. That is the power of profitability, and frankly, the debt issues as well, and losing money over time has on the company. It drives the share price lower because the value of the stock is lower or becomes lower over time. On top of that, it's enormously overvalued compared to its profits. PE is 33.7, price to cash flow 23.6. Forward PE can't be read. And again, if you've seen my other videos, I don't care much for PE or price to cash flow, but this number I do care about. EV to EBIT, enterprise value to EBIT. I look for anything below 8 to consider the company undervalued. It's at 63.3. What that means is that based on the company's current market cap, debt, cash, which is enterprise value, compared to its EBIT or its operating profit, the company is enormously overvalued. Why is that? Because of all the craziness that's gone on with its stock lately, and the traders and the short sellers and the hedge funds that I talked about in. I'm trying to get the screen back over here. In the GameStop video. AMC was one of those stocks that people went crazy on. The Redditors and the Twitter people tried to go after the short sellers because there are a lot of short sellers in AMC stock. And they made a lot of money and shot AMC share price up really high. People made a lot of money. Hedge funds lost a lot of money. But now that is kind of over, apparently, AMC shares cratered again. Why? Not because the movie theater industry will never come back after COVID. It will. But because right now it's in massive trouble of bankruptcy because of its enormous amount of debt. And because the COVID pandemic in most of the United States, most of Europe, and various other parts of the world is still crazy. We don't know when people are going to go back to theaters like they normally do. If that ever happens, and that's a big if, because a lot of these movie companies like Disney and Warner Brothers and others have started I don't know what they're calling it, the term, where they release the movie on the same day as they release it on their streaming service. Again, I know there's a term for it, I can't think of it off the top of my head. But that's becoming more of the norm, and that likely will become more of the norm going forward as well. So will theaters... Yes, they will come back. They won't go away no matter what, no matter if streaming... Well, it will become even bigger, but even if it becomes gigantic, theaters won't go away ever. Or at least not probably in my lifetime. As we currently know them, people want to go out to the movies. They like going to the movies. They like the surround sound. They like the experience. Stuff like that. But that will transform. It will cut into the revenue of the theaters. It will cut into the profitability of the theaters. It will cut into the cash flow of the theaters. Again, I don't know how much because that hasn't happened yet, because people are still afraid to go to theaters, or they're either afraid to go to theaters or they're not going to theaters because the production of the movies slowed down during the initial stage of the pandemic. It's only starting to kick up now. So that's another part of it, is there's not a lot of huge movies. We'll see what happens when the next major Marvel movie comes out, if it's a big hit. For example, in theaters. So there's a bunch of stuff going on here with AMC. The main thing it comes down to me, though, is the debt. The debt was too much when things were going well and when they were profitable. Now that they're not, it puts them at extreme risk of bankruptcy, which for the most of the last year they faced. And when I say months, literally until about, I think 2 weeks ago, they got a bit of a lifeline when their shares skyrocketed. It allowed some of their debt holders to convert their debt into shares. And it raised, I think, about $600 million for AMC, which saved them for a time from bankruptcy. Again, I don't know how long that will last. Depends on the COVID stuff, depends on movie theaters, depends on the streaming, depends on a lot of other factors. But for now, they look to be safe. But they still have far too much debt for me to consider them a buy, especially considering that their valuation is now crazy because of the huge run-up in share price. So I hope this helps. If I missed something, let me know in the comments below. If I didn't explain something well enough, let me know in the comments below. If you want me to look at a stock for you, let me know in the comments below. Again, this is for Kajona E. He's recommended, or I think 4 or 5 stocks now that he wanted me to look at. This is another one. I've done videos for other people as well. If you want me to look at a stock, let me know. I'll look at stocks anywhere in the world. The only stocks I will not look at are banks because I don't evaluate them, and insurance companies because that you have to actually dig into the annual reports to figure out if they're a good company or not. Any other stock, let me know, and I will look it up for you. If you're listening on the podcast or if you're listening on YouTube, much appreciated. Thank you very much. We'd also appreciate it if you like, love, share, subscribe, comment, all that good stuff. And if you subscribe, make sure to hit the notification bell so you're notified every time we release a new video, and we're releasing new videos all the time. If you're listening on the podcast, same stuff, but we'd also appreciate a review as well, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for some resources on how to become a better investor faster and how to evaluate stocks better and faster, we've got some free resources for you below. 5 free gifts, which includes the full preliminary analysis worksheet that I just did the visual part of here. You can also get a free PDF copy of my book, How to Value Invest. And you can also get our guide, 7 tips to picking great stocks and 3 times you must sell. You can get those at the links below this. All those are for free. If you're looking for more information on, or if you want some more one-on-one help from me, you can get information on our masterclass below. But until then, have a great day. Talk to you soon. Bye.